The Anup Engineering is a manufacturer of process equipments like heat exchangers, vessels, reactors, columns, and other things. Recently, they have announced an acquisition, they've announced some order flows coming in, and so much to talk about to Punit Lalbhai as he joins in to try and tell us what is the growth landscape looking like for a business which maybe you could argue, Punit, is still, if not in its infancies, then it's still in its earlier days, because it's not a very large business, but it's set up for maybe some strong things if analysts are to be believed. Could you describe in your own words, how do you see the next 2-3 years for the Anup Engineering?
Hi, it's a pleasure to be here. Very good question. I think the important thing to note is that we are in a very strong capex cycle as far as this industry is concerned. So you're right, it's a small business. We should be closing upwards of 500 crores this year. But I think we are poised for rapid growth. We've been guiding the market that we'll be growing for the next 4-5 years at 25% plus. And that is a reflection of the state of the industry, both domestically and abroad. And the demand is predominantly being driven by petrochemicals and oil and gas today, and also some strong demand in some renewable energy sectors such as green and blue hydrogen. So we see energy as playing a big role in the short term, oil and gas, and in the longer term, some of the more renewable forms. But the capex cycle is strong, and we are excited about future prospects.
Can you tell us, I mean, so is this more a return to demand from sectors which maybe, say, oil and gas was a bit dormant until recently? Or is it that you've introduced some product segments which are now catering not just to the erstwhile energy segment, but the upcoming or the longer term energy segment, if I can use that term, which is the renewables side? And is that what is giving you the confidence for this kind of growth for the next 4-5 years, or maybe more?
So there are many things that goes into why we are confident. I think the topmost one amongst them is our own performance and growth. Initially, we were very small. But now we've acquired marquee customers. We have a very, very good on-time delivery record. We have a great number of repeat and happy customers. And we are also at the same time in a very strong capex cycle that is looking strong for the next 3 to 4 years is what we all feel. So given that we have grown both in size and capability, that our track record has been excellent, and that the industry itself is in a growth phase. That's what's leading to the confidence.
Okay. So in order to live up to this kind of growth ambition that you have, would it happen through organic order flows in, or would you, like the way you've done with Mabel, and I hope the pronunciation is correct, but the way you've done with Mabel, you will have to resort to the inorganic route as well?
No, I think it will be a combination of both. So we've also created a lot of capacity. As of last year, we brought on stream our second greenfield facility at Kheda, which is an absolutely world-class facility. And phase 1 is in its last stages of investment. So it should be complete around the April-May kind of time horizon. And that facility should give us 200 crore plus turnover. Our existing order is good for 550 to 600. And then the rest will come from acquisitions. Mabel currently is around the 50 crore mark. We should be 60 plus next year at Mabel. And the overall potential at Mabel is to easily cross 100 and get towards that 200 figure in the medium term. So the existing capacity itself has a lot of headroom to grow. And at the same time, we'll be considering all opportunities. If an interesting opportunity comes along, we have a very strong cash position, good cash inflows, very strong order book for next year, and a good capex cycle to sort of give us some tailwinds. All of this put together gives us a confidence of growth, and it will be a combination of inorganic and organic.
So Okay, a couple of things. One, before I get to the export versus domestic side and what are you doing globally versus locally, just one quick word. Is the uptick in raw material costs recently a bit of a worry, or would most of these things be passed through? And part two of my question therefore will be that you are circa 20-22% EBITDA, if I'm not wrong, EBITDA margins. Sometime post-COVID, you've also clocked in northwards of 25-27% as well. So as you scale up, as the revenues inch up, and as capex picks up and reflects more in your order book, would the new normal be 20-22%, or could it be higher on the EBITDA front, EBITDA margin front, that is?
So I would say that the new normal would continue to be 20-22% for two reasons. One, we are increasing the sort of product complexity. And by product complexity, the main driver is more and more critical and exotic metallurgy. When that happens, the raw material as a component of the overall cost goes up. But the return per square meter or under the crane, that will continuously go up. So as the product mix shifts towards higher metallurgy, we expect EBITDAs to sort of come down somewhat, but overall profitability in terms of the return on effort, return on activity, return on square footage, that goes up.
Oh, so sorry, you're saying that while revenues, I mean, or two ways, I mean, you can slice and dice either way, revenues going up, but margins coming down, or that margins might come off from 2022 to maybe lower teens or maybe mid-teens, but you will still see revenue growth.
No. So we will maintain the margins at current levels, despite the product mix becoming more complex towards exotic metallurgy. And we are able to do that because operating leverage is kicking in that you were mentioning.
Got it. Okay, fair call. Now, just the global market versus the local market picture, Punit, because you are winning global orders too, I presume. So what is the current revenue mix, local versus export, or local versus global, as the case may be? And what is the current order book, right, in terms of local versus global?
So the current year, we should be at around 25% exports. However, the situation is very heavily indexed towards exports going into the next year. So next year, we expect the export percentage to be closer to 50% on a 700-ish crore opening order book.
Okay. And just in terms of conversations, I mean, whether through the Mabel acquisition, some other, or I mean, it might be an ideal mix for you to be able to attract customers that you might not have been able to thus far, and so on and so forth. Tell us what's the kind of order flow that you believe will come in. I speak to a lot of companies who are talking very highly about the kind of response that strong engineering companies in India are getting in the Middle Eastern geography.
Absolutely. So I think one has to understand that our product cycle is anywhere between 12 to 18 months. So in a sense, next year is already locked in terms of the capacity that we have created. We are almost going to be at full capacity. We have already confirmed orders of 700 crores plus, which will be a 25% growth from this year. Of course, we have to execute, which we've shown a very good track record of in the last few years. So that's where we stand on the opening order book. The two major geographies for us, as you rightly mentioned, one is the Middle East, and the second is North America, closely followed by Europe. So these are the three places where our products are being exported to. As far as Mabel is concerned, there are four things that we get through the Mabel acquisition. First is an expansion of product portfolio. So Mabel does products that we currently don't have in our basket. Products like silos, product like storage tanks, site fabricated equipment, all of that will come into our portfolio with Mabel. The second thing we get is proximity to our customers in South India. We have some of our very strategic customers down south, and being close to them is a big advantage, especially big and bulky equipment transporting them is a huge cost. So being closer to your customers is an advantage. And third, we will also have the capability of more engineering bandwidth that comes with Mabel. And fourth is capacity expansion. Mabel will be about 10 to 12% of our overall capacity going forward. And there is room to expand at Mabel as well. Today, only 6,000 square meters out of the 20,000 square meters possible has been built there. So we should be able to grow at that location as well.
Okay. My final question, what's the visibility like? 700 crores gives you the ability to grow at 20-25%, which is fine. But what's the order inflow visibility that you may have based on conversations that you guys are having with your clients for, let's say, FY25?
So it's looking very good. It's looking quite good. So our target would be to build up a similar type of growth number in terms of building up the order book for the year after during this year. So currently a lot of projects are being announced. The capex cycle is robust. So we are pretty confident that we should fare well going forward.
So sorry, and I'll just wrap up the interview with this. Is this the normal book-to-bill ratio that you would typically operate at, or could it, in your business, or could it be actually higher as well?
No, so I think it's important to maintain your on time close to 100% in this business. And that's what's given us the ability to move up in terms of complexity, in terms of metallurgy, in terms of the level of trust we enjoy with the customers. So your growth has to stay in very closely in pace with the capacities you build. And so we are currently doing that, very, very precisely and comfortably. So we've built the new facility at Kheda. That facility has started operating at the right levels of efficiency. Q3 and Q4 met the dispatch targets from the new location. And we are in the final stages of completing the full phase 1, which is 2 bays at Kheda, that should give us 200 crores. So that matching has to happen. And the investments and the order inflow have been planned to be able to grow at this 25%, hopefully, if things support at 30%. So hope that answers the question.
It does. Thanks so much, Punit. And all the best for the quarters ahead. Much appreciate you speaking to us today.
Pleasure. Thank you.
And viewers, that's the view from Anup Engineering. Thanks so much for tuning in.